Yeah.
Do you want me to send that to you?
What restaurant?
On the French market, like a.
I don't even know if it's gonna be there.
Like,
Yeah.
I don't know, like that fucking. Yeah, it's like, there's like. In there, it's like.
What?
Where to play.
Yeah.
No. Cancel the test. Cancel the test, I would go.
I wish you would just make it. Like, no
You
class,
can't do that because he's who the big cheating scandal was. There were like 18 people with the exact same answers. And they all got
No,
60
the current branch I'm at is.
on a multiple choice test. Like, no, you got four.
So Drew, can you guys hear me?
That's why we live in the
Somebody give me a.
If it's these 200 people, there's 30 people in the class, so we're all spread out.
I figure out what.
It's just the second floor. Yeah. Big buildings where first Wednesdays are. Like,
Just.
I mean.
Okay, guys, it says it's working on my end, so I'm gonna go ahead and get started here. I will share my screen. Okay, just a little reminder to everybody that the first exam is open. You go out to My Business Course website and click on exam 1. It's gonna boot up that exam and you'll have 120 minutes to take it. Just remember, it's a timed exam, so if you are counting on it being open book, open note, which it is, all the material in this class is available, so use it. But you won't have time to look up all the answers. You need to be familiar enough with the material to get through 60 to 70% of a multiple choice test. And then you'll have 10 or 15 questions where you'll have time to go back and look them up. And I generally get pretty good results on the first exam. Last week, I went in here and I clicked on edit settings and opened the exam. Let's do a quick little reminder. The timing of that. See, I opened that through February 21st, so that's next Tuesday at 11:59 p.m. You have to have it submitted by 11:59 p.m. or it's just going to take whatever answers that you have outstanding at that point in time. That's caught at least 1 or 2 students in the past, so just heads up. That'll be great. Any questions on the exam?
Will the answers be released whenever the test closes?
Not as soon as you submit your exam, but as soon as everybody,
That's what I mean, like.
Yeah.
At the end.
yep. When 11:59 hits on Tuesday night, you'll be able to go in there and get feedback.
I probably won't be awake right then, but.
All right, well. Yeah.
Just make sure I'm not wrong, but the homework assignments, do they close at the end of the exam too? So.
No, they're open all.
Even so, you still get points.
Yeah, it's, you're a procrastinator, I consider you to be one of us. Yeah, so I'm very friendly to procrastinators in this class. You can put that homework off until 1st of May and then cram it all in. That's fine by me. And the purpose of this whole exercise is to try to impart a little bit of knowledge. So I don't care when the knowledge gets imparted, just that it gets imparted at some point. And so, yeah, by all means, put it off. Now, I talked a little bit last week about how I try to curve if necessary. I haven't had to do that in a couple years, but I have in the past. So if the scores are a little low for whatever reason, I'll go ahead and try to make some adjustments. And I look at who has their homework done and who doesn't have their homework done as an indication of whether or not, I don't know, it's fair to give you a curve. But we'll address that that presents itself. Homework. Research project. Please ask your questions now, and I really, because I can't tell you how often I get to the end of the class and somebody's got a question. And I'm like, oh, wish you would have asked that during class. Because it saves me time, because everybody has the same questions.
Kind of vague, like how far should we kind of like you got a research project, maybe like midway through the like how do you kind of like think about that?
I will tell you what I tell people to do, and then I will tell you what people do. What I tell people to do is to build this research report module by module, so that when we're working on module 5, which is revenue recognition and operating income, I want you to pull up a company's 10K filing, go find their revenue recognition policies, and then come to some assessment about whether or not you might need to adjust the accounting. So tonight I'm going to talk about Pfizer and Raytheon and probably Boeing. They all have unique revenue recognition policies. At this point in the semester, module 5, you should be familiar with that. And maybe just capturing some of the language in the 10K so that you can include it in your report. If you do that module by module, then this is pretty easy to put together at the end of the semester. What actually happens is everybody puts it off until like module 11 and then starts to feel the overwhelming stress of compiling a 50-page research report in the last couple weeks of class, which is one of the reasons why I finally got rid of the comprehensive final in this class. So that's great news. And a perfectly acceptable strategy. You know, you can procrastinate on that research report too. I think there's a lot of research out there that shows that procrastination focuses the mind on, you know, a select few who thrive in that environment. So by all means, do my guess.
I think you.
Will we submit the homework advance, or we can submit it again and again?
You can submit it again and again and again and again. Take it once, see what the questions are like, try your best to answer them. If you don't get the grade that you'd like, take it again. It's a good way to study for the exam too. And there's a sample exam tests out there. Make sure you click on those and get a sample of what the questions are like. Okay. So it is Happy Valentine's Day. It's just the Lovely Hearts Club that we have in class today. We're a little bit light. It's 5:40. I've done absolutely nothing for my wife yet today, so I'm thinking maybe on the way home I swing into Trader Joe's and get her some flowers. But I'm open to ideas too. You know, there's some basis points and extra credit for anybody who can bail me out of my current predicament. This is not unusual. Fortunately, I've spent 20, gosh, what? How many years have I been married? 23 years lowering the bar in terms of expectations. So I should be all right. But yeah, your advice is welcome. Okay, let's talk revenue recognition and operating income. I always kind of laugh at this lecture because we're in that period of time where the first exam window is open, but we're talking about material that's not going to be tested on the first exam. So how do you get that lecture through? You know, there's only so much room up here. If your mind works like my mind, we got to push out something that's going to be tested this week in favor of something that's not going to be tested for 4 weeks. So we'll try to make it as interesting as possible and ask questions as we go. That would be great. Longer. Go. I went through this lecture again for the 10th time before class tonight, made a few notes that I wanted to share. And I think there's a chance I might be able to get us out early tonight. Let's see if we can make that happen. Okay, so very high level. Let's just have a conversation about what revenue recognition policies are. There's a whole chapter devoted to it in our book, a whole module about revenue recognition policies. And just like I mentioned with my advice on the research report, I want everybody in this room to pull up the 10K and flip to the back and familiarize yourself with the section that says revenue recognition policies. So we've all had accounting and finance and some exposure to this material. Somebody help me out. So it's not just all me talking up here. What's the revenue recognition policy, Thomas? I got your card today. I'll pick on you. Graduating in 2023
Yes, sir.
and working at Lockton.
Yes, sir.
Right on. So, what is a revenue recognition policy for Lockton? What are we talking?
Oh, this is not an area where I know a ton about. I'm gonna people stab at it, I guess.
Let's start with what's revenue.
Oh, well, revenue is money that comes in the door.
Okay, so
Is that how you like, is that how you kind of like spread it out over, or that like amortization, is that the same thing, or am I way off base?
yeah, well, the money that comes in the door and amortization are two keywords I'm gonna focus on
Okay.
there. Because we've talked about in this class already a little bit, and everybody's covered in their accounting class that. The money that comes in the door and the revenue that we recognize. Are not necessarily the same thing. Because of generally accepted accounting principles. And we're gonna go through the accounting tonight and identify areas where they vary. So a revenue recognition policy and just revenue in general is a little bit of a phantom topic. It is not necessarily anything. It is meant to track business activity. But in a lot of respects, it's just promises that are made to pay us at some point in the future. But that future may or may not come. We might get paid, we might not get paid. It still ends up on our books as revenue.
Is this the concept that got Enron in trouble? Is that like the same thing, or maybe there's something else?
Yeah, this is a big part of what got down. Yeah, they were basically booking fake revenues all over their income statement. No question.
Is this like a cash flow cycle thing? Is that related to this?
It is related to this. When we track cash flow, the cash conversion cycle, we're tracking how long it takes us to collect the payables or like our accounts receivables. So tonight we're going to talk about accounts receivables. Anytime we make a sale on credit, revenue shows up on our income statement. We're not accountants. This is not an accounting class. It's just our job to know when the accounting is bogus. So we're going to talk about when those revenues might not actually match the cash flows that are generated in the future. There are a handful of instances that we'll focus on. I also want to touch on something called revenue quality, or ultimately earnings quality, which is that dang maybe somebody's awake. Earnings quality, I think of as how real are the numbers on the income statement? How real are those earnings? When we book revenue, because we just sold a good or a service on credit, somebody promised to pay us, that's accounts receivable and revenue is booked in that transaction. How likely is it that we're really going to get paid? If it's not very likely, if we make a lot of sales that are booked with deadbeats like Vern Cushenberry that don't ever pay, well, those represent low quality revenues and ultimately low quality earnings. And I want everybody in this class, this financial analysts, I want you to be able to draw that distinction between high quality and low quality earnings. Am I getting feedback?
Someone has their mic on.
Oh, okay, Zoom crew, somebody's got their mic on, will you all go mute? Never mind, I think I can mute myself. Okay, there we go. If you want to ask a question, please unmute yourself. I was getting a little feedback. Okay, that's high level. Here's one of my pet peeves, I can't function with. Sorry, PowerPoint can't read. Slideshow. Animation. Here's Pfizer's income statement. When we talk revenue recognition policy, we're trying to get at the root of how valid is this $53 billion in revenues that Pfizer booked in 2018. They didn't collect $53 billion in cash. We know that because if we put the income statement side by side with the cash flow statement, we're going to see that those two numbers don't match. Well, hopefully, eventually, all those accruals that we make as in the accounting will reconcile, and we can call those revenues high quality. But that's not necessarily the case. As you dig into the accounting, you're going to have to find numerous instances where the management teams are being a little aggressive with some of their accrual accounting. And I'm going to talk about a few of those tonight. We're going to look at Levi's and give you a good example of how management teams might be playing that game of find the penny that I like. So the revenue recognition rule changed in 2017. If you go back before 2017, just be mindful that there were different rules governing the accounting treatment. So you might not be comparing apples to apples, but at this point, anything 2017 and after is governed by the same accounting. So that gives us plenty to work with here. Okay, here's the 5 steps that FASB put in place with the adoption of the new revenue recognition accounting policies. We as management teams or management teams of any of the companies that you're going to be looking at this semester, they have to go through these 5 steps. They have to take a look at the contracts that they put in place with the customers. Now, if we're Walmart or Snip and Clip or some outfit that's selling goods or services that can be delivered in real time, revenue recognition policies are not material to the analysis that you'll probably be doing on your company. Okay, great. When you get to your research report, you're just going to be able to say, Module 5, reviewed the revenue recognition policy of your company, not material to the accounting, no adjustments necessary. That's just a check the box exercise to show me that you didn't ignore Module 5. You looked at the revenue recognition policy, there's nothing material about it, didn't affect the accounting, you can move on. Not all the companies that you're working on will have relevant accounting for every module. The example I like to use is next week or the week after, I forget which, we're going to be talking about the accounting for operating and capital leases. If you're Southwest Airlines, that's a big and material part of any analytical work. If you're Pfizer, maybe not. So that how you construct that research report will be different for everybody in class. These policies that we're going through, first identifying the contract, then identifying any performance obligations, determining the transaction price. They sound pretty simple, but they can be very, very complex, especially when you're dealing with companies like Raytheon as an example that the authors give, Jacobson Engineering, Foster Wheeler. I did some work on Foster Wheeler early in my career. They build nuclear power plants. These are long-lived contracts that can span 5 years or more. So imagine inking a contract. So you just sold a deal to build a nuclear power plant, and then the work begins. Now you're going to get paid with milestone payments over that 5-year period. So how do you book the revenue? You don't want to put 5 years worth of expenses on your income statement, and then all of a sudden in year 5, book a $5 billion payment for the nuclear site that you just installed. Well, those financial statements aren't useful for anybody. They're not useful for your banker. They're not useful for investors. They're not useful as accounting statements for employees or outside stakeholders. So we need to book that revenue over time. We need to show the value of that contract, which will be disclosed in the 10K filing. And then the nature of how we book those revenues will also be disclosed in the filing. So we have these three steps that we go through: price, performance obligations. Then we'll look at the allocation of that transaction price. So over that period, by the time that contract is fully satisfied, we're gonna book the complete price of the facility. And then all of the milestone payments and service requirements to recognize those revenues are gonna be spelled out in the 10-K. One of the most complex revenue recognition policies I ever looked at was Boeing. Boeing has a revenue recognition policy that they call procurement accounting. And it allows for them to book the revenues from the sales that they make on their airplanes, which many times are 3, 5, sometimes 7 years in advance. Boeing will go to Southwest Airlines and they'll book a contract, and the life of that contract can be a decade or more. And with all of those sales, they can launch I guess new plane lines, and they call it a new program. So when they built the 787, this was, I don't know, when they built the 787, it was probably around 2006, maybe 2006, 2007. The 787 was the first plane ever built with a carbon fiber fuselage. So they went out, they contracted for all these future revenues, and that allowed them to build the facilities necessary to make these planes. And they recognized that revenue across the whole program, and they defined the program from groundbreaking and the building of the facilities to the manufacturing of the fuselages, and then typical production line manufacturing that you think of, typical with any manufacturing firm, and then ultimately the sale and delivery of those planes through the life of that contract. All told, it was 10 or 15 years, and the accounting for that, milestones for that, transaction prices for that spread across many buyers was complex. You're gonna get to have the pleasure of sorting through all that when you look at your 10-K filing and try to analyze the revenue recognition policies of whatever company they're in.
Like, which part of the 10-K is typically revenue recognition policy typically in? Like, is it like?
It'll have its own section typically.
Okay.
You're gonna look for something that says revenue recognition. So it's not hard to find. Okay, here is Pfizer's disclosure. And I wanted to point out some of the language in this. So that was a timely question. This comes right out of Pfizer's 10-K, and you can see here, you'll be able to just search for it. If you pull up the PDF doc, you won't have any trouble finding this. So in Pfizer's 10-K, you'll see that their gross product revenues are subject to a variety of deductions, which generally are estimated. Now, anytime you hear the word estimated, I want a little pink flag to go up, because who makes those estimates? What was, somebody said it?
Management.
Management makes those estimates. Management, as we all know, because the very first assignment in this class was the proxy, they get paid usually through some incentive comp methodologies that may or may not be aligned with our interests as stockholders. So estimates give managements the opportunity to gamify or manipulate the accounting. So these gross revenues are subject to a variety of deductions, which are generally estimated. And those deductions include chargebacks, rebates, sales and allowances, and sales returns. So these are the 4 primary categories that we're going to be looking at when we're trying to assess the quality of a company's revenues. We're going to be looking at chargebacks, rebates, sales allowance, sales returns. These deductions represent estimates, again, of the related obligations. And then And as such, they're very, very clear about this. And as such, knowledge and judgment is required when estimating the impact of these revenue deductions on gross sales. Somebody translate that for me. You could if you're a cynic, like yours truly, you could translate that as, at the end of the day, we're gonna report a revenue number that is the revenue number we want to report. Because there's so many fudge factors in this.
We're just gonna give you a number we like. Does every company, like pretty much every company, have recognition policies similar to that, even if they don't take advantage like of it, like in a malicious way? Do they all kind of like give themselves that leeway if they want to? So it's like what kind of getting at is like, it's hard to tell if they really do use it maliciously versus just having that like leeway with, I don't know how I'm phrasing it right. But
No, that's this class.
Okay.
The question you ask is why we come here on Tuesday nights, because we want to know, is management shooting us straight, so to speak? You know, we know what the intent of the accounting is. Are they living up to the intent of the accounting? And to answer that question, we're gonna tear the accounting apart and look at half a dozen different ratios over time compared to their competitors and see if we can come up with any variations that would lead us to believe that there might be something a little off here. Or does it pass the smell test? Well, if you look at a company like Pfizer, and let's just look at, okay, this is a very common adjustment to revenue, sales, returns, and allowances. We'll look at Levi. You know, you buy a pair of jeans as a gift, they don't fit, somebody brings them back. Levi's is a company that's 100 years old. If you see that their sales returns have been 3% of total sales for the last decade, and they're 3% estimated for next year, that's going to give you a lot of confidence as the analyst that, yeah, that passes the smell test. Okay, but now you look at Levi's and you see that, well, for the last 10 years, each and every year, 3% of their sales have been returned. And next year, management is forecasting 1% of their sales to be returned. Does that pass the smell test? Well, maybe not. The variability becomes obvious when you put this into an Excel rows and column spreadsheet, and then you graph it, because you're going to get a little line, and then it's going to look 3%, boom, drops to 1%. What's going on? That's financial statement analysis, 5561 or 419, whichever one you're in. We're trying to answer those questions. So here are slide number 9, talks about some of the more common scenarios that companies find themselves in that might have unique revenue recognition policies. Look at any and all of these that might be disclosed in the 10K, non-refundable upfront fees, consignment sales, licenses, franchise, variable consideration. Our authors give us some examples of what you might think of as quote unquote typical accounting treatment, but any of these can have very unique, very specific and very customized revenue recognition policies, which is one of the reasons why this material is so complex. And one of the reasons why I think it's worthwhile to take this class, because if you can get really good at this, that there's opportunity. When there's opportunity to manipulate the accounting, there's value there for somebody to go out and become an expert, so that others can lean on you as the expert, so that they can have confidence that nothing's going on with a little untoward with the management. Okay, further, there were 2 slides on just nuances of revenue recognition policy, okay, I want to talk about some of the subtleties of recognizing revenue. I gave the example of a large construction project That's a good example of what you might see as cost to cost. Our authors use Raytheon, and you can see Raytheon has a policy whereby revenue is recognized based on the extent of progress, and they're gonna use a cost to cost measure. It's fairly simple. If Raytheon books a project for $100 million, and 1 year into that project, they've accrued 15% of the expected expenses over the lifetime of that project, they're similarly gonna book 15% of the revenue. Okay, you just heard me use one of our pink flag words, which was estimated total cost. There's another opportunity for management to manipulate the accounting, because management has control over what they expect the total cost of the project to be. So if they expect the total cost of the project to be more, or they are realizing costs at an accelerated rate, they can budget that one way, one direction or another to recognize more revenue or less revenue in a period of time. So how would you play the game? How would you put your analyst skill set to work to come to some recognition, some conclusion about how management might be utilizing a cost to cost method of accounting to recognize the revenue? Well, that one's tough.
I was just gonna say, if I notice a percentage of like that expected of the costs that they're, or the revenue that they're accounting for is either increasing a bunch over time, like, for example, like 15% in 1 year, but like 30% the next year, that would immediately give us like, how are we progressing so quickly in 1 year?
Yeah, you're asking the right questions, and you might have to be something of a construction engineer or expert to understand how those costs are going to accrue. I am not, especially when it comes to Raytheon, but that's what we're still talking about here. But there are experts that you can talk to. One of the first companies I ever did research on was Chiquita. Bananas are a horrible business, by the way. Don't ever get into bananas. Just absolutely terrible, commoditized business. Periodically you'll get an opportunity to buy a bad business at a really good price, so you can make some money on bad businesses, but generally just don't do it. At any rate, I was doing work on Chiquita, and why do you care about Chiquita? I lost my train of thought. What was it? Something to do with Chiquita's revenue, right?
Yeah, the like over time, like if like the revenue recognition is being like, for example, if I complete 15% of project in 1 year, but then 30% of the project the next year. How that, I guess my question then becomes how are you progressing over time so much? Like,
yeah, it's the right question, and time series analysis will help you do that. Oh, I was talking about the challenging aspect of just doing the job of a financial analyst, because at times it will require the knowledge of an expert to tell whether or not your management team is being honest with the accountant. So to learn more about the banana business, I went down and I got to know the local produce guy at the Hy-Vee, and in one afternoon he taught me more about just fruit in general, but then bananas specifically, than I probably could have learned in a week sitting behind my computer. So in the scenario that you raised, it's going to be your job to reach out to, maybe an ex-employee of the company, maybe a manager of one of their competitors, where you can ask questions. Does it seem reasonable to you that Raytheon would be booking their revenues in such a lumpy manner? Reading anybody follow Michael Lewis? Michael Lewis is he wrote Big Short, right? Wrote The Big Short, wrote Liar's Poker, wrote Moneyball, wrote The Blind Side. It's terrific. Check out Michael Lewis. The Big Short's probably. He also wrote one on high frequency trading called something Boys, Flash Boys, another great book. He's writing a new book on Sam Bankman-Fried and what was the name of his company?
FTX.
FTX. So I'm listening to the podcast and he hasn't released the book yet, but he's talking about all the background research that he does to write the book. And as part of the background research, he interviews all these subject matter experts. And he said, all the research that I do on background is just that, it's background. It never makes it into the book, but it's an interesting process to go through. So he's turned this into a podcast. And that's kind of the same mentality that you have to be a good financial analyst, because so much of what we study in class falls within that range of reasonableness. Like, it's hard to really know if there's something going on, something shady. To really know that, you have to be an expert on the business. So to become a good financial analyst, you have to have resources at your fingertips to draw on so that you can distill whether or not there's something shady going on with the accounting. And I think what you'll find is that the best financial analysts that make a name for themselves on Wall Street do it over a period of time and build a reputation that's so strong, it gets them recognized by others in the industry. And I think it's not uncommon for, like, say, the CEO of Raytheon to have a very quick command of who the best financial analyst is on Wall Street, because they'll ask them questions about the nature of that business that are so insightful, which you could only draw on after you've been covering the business for 10 or 15 years. And that's a great job. It pays really, really well. If you're a curious person and just enjoy the nature of accounting and finance, put that on your exploratory list. Okay, here's the accounting for that cost to cost method. I'm not going to go into it because it's so simple. You just need to know that the revenue is recognized in proportion to the expenses. What I do want to talk about is sales allowances. I want to share with you some of the ratios that we look at to examine sales return. So here's that example that the authors used with Levi's. Let's walk through this. So assume the following for Levi Strauss. They sell jeans to a customer for $130 on account. So they're selling those jeans on credit. There's no cash coming in the door, but there's jeans going out the door. And they expect for 3% of their sales to be returned. So there's that 3% number I mentioned earlier. Here's the accounting for that. We're going to book revenue for 130 right down here. Here's sales. We're going to book that net of $3.90. $3.90 is what we put in sales returns and allowances. That makes our gross profit number $48.50 after our cost of goods sold. If you go to your 10K filing, look at the disclosures, you're going to see how these balances vary from year to year to year. These balances are important because they're going to allow us to compute the ratios that we need to normalize all these numbers. So as sales increase, we would expect for sales returns and allowances to similarly increase. That's why we need to look at it proportionally to be able to identify any anomalies in the numbers. You'll see that Levi's has a table for sales returns. They also have a table for sales discounts. Pfizer had another 2 or 3 that they dealt with on an annual basis. You'll see all those numbers disclosed in the 10K file. What we want to look at are gross additions, but then we want to look at those gross additions relative to gross sales, and we want to calculate something that we call an adequacy. That's ultimately what we're concerned about is Levi in this case. Are they reserving enough against those sales? Because we report revenues net of sales returns and allowances. So gross revenues less sales returns and allowances, because we know some of those sales are bunk. Some of those sales are not legitimate. We want to get that estimate as close as we can possibly get it. So we're going to look at historical activity, make a reasonable assessment, and net those sales off, so that we show gross sales on the income statement. And if everything's working like it should be, if you owned the company 100% outright, then you would engage in an honest effort to get that estimate as factual as you could possibly get it. And when we're giving management teams the benefit of the doubt, that's what we hope they're doing. I think if you owned 100% of the stock of the company, that's exactly what you would do. Because you would want that accounting data to be the most accurate representation of the true underlying economics of the business. Because if you have the most accurate representation of the economics of the business, you can make more informed decisions about where you want to invest your capital going forward. So here's the ratios that we look at for that. We can look at the additions charge. So additions in this case means more sales returns, more sales discounts. In 2016, Levi booked 10.3% of gross sales as sales returns and sales discounts. In 2017, that dropped to 10.1. And then in 2018, that dropped all the way down to 9.8. Could that be concerning? Let's look at more ratios. Maybe. So let's look at the allowances account to gross sales. This is the total amount of reserves that we've booked relative to gross sales. 2.8 in 16, 3.3 in 17, 2.8 in 18. Well, that all seems within a range of reasonableness. Now let's look at adequacy. Adequacy is reflected by the estimated amount. That means the amount of sales returns that we booked in a given year. And we're going to divide that against the amount of sales that actually came back. What was true? What really happened? Well, in 16, our adequacy was 104.3%. That means we accounted for more sales returns than what actually happened. That's conservative accounting. We'll give Levi's a gold star for that. In 2017, their adequacy, their total reserves went up to 107.9% of sales returns and allowances. So there's my American counterforce. I can delete that one now. We're not going back to that one. I told you this story last time we got together. My wife booked this for American counter class and we lasted 8 minutes into the video. Well, we went over to the Super Bowl party with 4 other couples that were supposed to be taking this class. None of them made it past 15 minutes, so I felt better. I can take my reminder off my watch. So here our adequacy dips to 98.7% in 2018. Now that's a big swing. That's almost 10%. Okay, now I'm starting to wonder. No alarm bells are going off just yet, but that's a big swing. So, analyst adjustments. This is a big part of this class. Anytime we see accounting vary from period to period to period, we want to recast the financial statements. We talked about recasting last week, also called recharacterization. This is just our financial analyst magic wand where we change the financials. We're not accountants. We are using the accounting, we're using these numbers for our own purposes. We can do whatever we want. We got our spreadsheet, we got the financial statements, we can make these things sing and dance so that we can better understand them. In this instance, we're going to look back over the last couple of years and we're going to say, hey, Levi, whoever we're talking about, your charges to gross sales number has averaged 10.04% for the last 3 years. What makes this year any different? If we can't come up with an answer to that question, what makes this year any different? Then it's probably not different. And we should be applying a 10.04% number to the accounting. Well, we can do that. We just recast the financials. we say, hey, what does 10.04% of gross sales look like? That becomes our new additions number. We put that sales returns and allowances into the income statement. We rework the income statement so that we have a new earnings number, new gross margin number. It's going to flow through all the way down. We know how the accounting works. When we do that and we apply an average ratio, we see in 2016, our net income goes up by 9, I think these numbers are, 9 million. In 2007, the net income goes up by 4 million. And in 2018, the net income would decline by 13 million. So we saw what looked like maybe kind of sort of management team might be getting a little bit more aggressive with the accounting. And now we've just answered the question, well, what if they would have used numbers that looked like the recent past? If they had used numbers that looked like the recent past, their net income would have been lower by $13 million. We're playing a little game of find the penny. Right there, they probably just found it. If you've looked at Levi's proxy and you know that their CEO gets paid based on earnings per share, it's likely that little maneuver just cashed him or her out. And if they happen to be retiring in that year and their option package is vesting based on that earnings per share number, well then, ding, 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 that's your red flag that you probably just found, suggesting that the accounting was purposefully manipulated to get somebody paid. With me? Questions there?
Is this an example or did this actually happen?
These are real numbers. Now, what I don't know is if Levi's management team had any incentive comp linked to earnings per share. Somebody asked me a good question last week, which is it typical to have incentive comp linked to these numbers? Yes, it is typical, but incentive compensation packages get very complicated too. What you'll see are smoothing techniques so that management teams' incentive comp will actually be linked to some moving average over the last 1 year, 3 year, 5 year period of time, with only 10% of their total comp linked to that metric, with another 20% linked to another method, and maybe 50% linked to the stock price. And those could be options that vest over a period of time, restricted stock units that vest over a period of time, phantom stock units that vest over a period of time, or just earnings participation investments. So that gets very murky, and it's really beyond the scope of this class to be able to tease all that out. But it's within the scope of this class to simplify it a little bit. And then when you're in practice and you have 40 to 60 hours a week to devote on just this topic as a profession, yeah, tease that out. You'll be able to go deep into that topic. But we make a few simplifying assumptions in this class. Yeah, that could have been done to get somebody paid, but I don't know that. There's a lot of other reasons why that might have just manifested on its own too. Or, well, this is Levi's, and this was 2018. I don't know what was going on in the fashion industry in 2018, but they could have done something with their line that led them to believe they were going to have fewer sales returns and allowances. I'm struggling right now to come up with what that would be in the fashion world, but it's a legitimate strategy decision to think that when a company pivots, it would affect their relationships with clients in a favorable way. And you can sell that story to Wall Street, and sometimes you can sell that story to yourself. And that might have resulted in numbers like that. Okay, deferred revenue, just a couple comments on deferred revenue. Firstly, it's the same thing as unearned revenue. Save yourself some time and grief and pair those two things in your mind so that they are one and the same. Deferred revenue and unearned revenue are exactly that. We record it as a liability on our balance sheet because it has not yet been earned. Earned is denoted by the transfer of the good or service to the client. In this instance, we've received the cash, but we have not transferred the good or service to the end user. That job that we have to do represents a liability. We have to go out and do something, got to do our job. And until we do our job, that cash sits on our balance sheet as a liability. So cash comes in, debit the asset, unearned revenue is the liability that sits on the balance sheet, credit the liability, and that transaction is reversed when we actually perform the good or service. Here's some examples of deferred revenue related to Lowe's Corp. So Lowe's Corp has service revenues. Sometimes they will collect cash for services that are provided by their subcontractors. So you go into Lowe's, buy a new floating floor for your basement, pay them $2,000 to do the installation. They haven't earned that cash yet because they haven't done the installation yet. When they actually do the installation, they will have earned it. Until then, shows up on their balance sheet as an unearned revenue. Same thing goes for store value cards. You buy a gift card at Lowe's. They receive the cash, but they haven't delivered a good or service, sits on their balance sheet as a liability called unearned revenues. Same thing for extended warranties or protection plans. Just be familiar with those. It's likely that the company you're doing work on this semester has some deferred revenues on their books. Find out what they're related to, find out how they manifest in their business, and come to some determination about materiality. And I hope you're kind of picking up the cadence that I go through when I'm trying to share with you what's important and what's not. Materiality is huge. Materiality is basically a number that means, does it matter? Pfizer, we just looked at Pfizer, they had $53 billion in revenues on their income statement annually. So if you get into deferred revenue or sales returns and allowances or any other accounting policy we're looking at all semester, and you find out that they have $2 or $3 million worth of entries relative to an income statement that's $53 billion, that's not material. What's material? Well, that varies for every company that we look at, but you could probably use a threshold of 1 or 2% in this class. If it's above 1 or 2%, and it could have a meaningful impact on earnings per share, or if you get any whiff that the accounting might be used in that game of find the penny, that becomes material. Otherwise, it's a check the box kind of exercise. And you can just illustrate to me that you spent the time to look it up in the 10K filing, just copy and cut, and then give me some commentary that says, looked at it, it's not material, moved on. And that's sufficient. Okay, foreign currency. I'll touch on it here, and then we go deeper into foreign currency in, I think it's module 10. So what our authors are asking us to recognize in module 5 is that foreign currency can have some effects on both the income statement and the balance sheet. We have to translate income statements back into US dollars on an annual basis. So take a company like Pfizer, we're going to look at, I'll just go straight there. Here's Pfizer's policies. Most of the companies you all are working on this semester are global in nature, which means you're going to have business done in other currencies. This is Pfizer's disclosure. Find the disclosure for your company. And it's going to read something like this. You see, Pfizer sold 53% of their total 2018 revenues were derived from international operations. That's a majority of their revenue coming from overseas. You could argue that Pfizer is a global company, not even a US company. So that included 21 from Europe, 22 from China, Japan, Asia, so on and so forth. If the US dollar were to weaken against other currency, assuming all other variables remained constant, our revenues would increase, having a positive impact on earnings. How do we get all this data back into dollars? Well, we have to do it at the end of the year, and we're going to do it at an average currency exchange rate. So if the dollar's going up, that's bad, meaning that the earnings reported in US dollars will be smaller. If all dollars are going down, that's good, meaning that the earnings reported in US dollars will be bigger. The economics are the same, economics are identical, which is why we need to train ourselves as analysts to have a very keen awareness of the fluctuations caused by international currency translation adjustments, because over time, they typically even out. Now, here's the magnitude, check this out. Revenues in 2018 increased by 1.1 billion or 2% year over year, which reflected operational growth of 791 million and the favorable, meaning the dollar depreciated, impact of foreign exchange of $310 million. So they booked a favorable impact. That means their revenues went up by $310 million. That's a third of their year over year growth was due to foreign currency translation adjustments. Now, what did management do to earn that? How much credit do we give Pfizer as a business? How much credit do we give their management team? If we're thinking like an owner, I want everybody in this class to think like an owner for everything that we do. If you owned Pfizer and you had just hired the CEO, and then you got these numbers reported to you on your desk and you're reading this disclosure statement. Well, do you go into the CEO's office and say, well done? Or are you saying, I'm not going to give you that much credit for the 310 million. I'll give you credit for the 791 number, good job. But I'm not giving you credit for 10 million. It's our job as an analyst to be able to factor that out. And that's exactly what we wanted. When we pull together our time series data, so now you're working in Excel and you got 10 columns to the left, and you're pulling together the financials for 18, 19, 20, 21, 22. We're going to remove all those foreign currency adjustments and recalculate the growth rate. That's what we're going to give our management teams credit for. That's what we're going to use to forecast our financials into the future. If minus foreign currency adjustments, Pfizer's been growing at 2% for the last 5 years. What do you think they're going to grow at next year? Probably around 2%, unless they got what's Pfizer's big growth. It was Lipitor. I don't know that Lipitor's been off patent for a few years. Now, I don't know what the big drug is now, but a drug pipeline.
With our project, do you want us to copy and paste that entire section into your paper or just?
Snippets would be fine, but this thing, something like this, that's not too big to copy and paste. That's exactly what our authors did or textbook. We just copy and paste that in.
Is there a limit to how much you want us to copy and paste in?
It's just enough to get the point across. Yeah. Okay, so that's that. That's foreign currency. And then our authors give a couple of examples of how foreign currency can affect the company's balance sheet if they have borrowed or lent in a foreign currency. Pretty self-explanatory. I'm not going to go into them in class here. Okay, I want to do accounts receivable. Very much like sales returns and allowances. When we book a sale on credit, whenever an accounts receivable hits our balance sheet, we know a certain percentage of those credit sales are going to go back because stuff happens. You can't get your payback. Buy something on credit, which is really revenue in exchange for a promise to pay you later. It's not cash, it's revenue in exchange for a promise. Some of those promises go back. We know that. Companies know that from day one. As soon as those revenues hit the book, we know some of them are bunk. So we're going to make that adjustment, just like we did for sales returns and allowances. Whenever we book an accounts receivable, we're going to note that some of them go bad. This is typical of what you see in most 10K filings. Companies will parse it out. They'll use historical data to inform this decision. And in this instance, the historical data shows that this company estimates that 2% of existing sales will go back. 3% of all, I said that wrong, 2% of existing accounts receivable, not sales, accounts receivable will go back. 3% of all accounts receivables, 1 to 60 days past due will go back. 4% of accounts receivable 61 to 90 days past due, and 8% of any accounts receivables greater than 90 days outstanding will ultimately go back. So they'll use these estimates and they'll parse their accounts receivable out by days outstanding, and they'll come up with some estimate for what their accounts receivable allowance should be. Slide number 38 shows how we book that on our balance sheet. We're going to book $100,000 in accounts receivable and then immediately book credit in the allowance account. Allowance for uncollectible events. And then just like sales returns and allowances, those are reported on the balance sheet net of one another. So we show gross accounts receivable, net of sales, accounting for bad debts, and then net accounts receivable. Okay, here's how we audit that. These ratios are what we would use to identify any anomalies in a company's reserves for accounts receivable. Last week or 2 weeks ago, we talked about the cash conversion cycle that came up tonight already. Accounts receivable divided by, or sales divided by average accounts receivable is part of that cash conversion cycle. Another very similar ratio is days sales outstanding, where we just take the number of days in the year and divide by accounts receivable turnover. For Pfizer, we see that their accounts receivable turnover amounted to 6.6 times, and their days sales outstanding amounted to 55.3 days. Those are two great ratios to chart over time. Put the last 5 years worth of accounts receivable turnover numbers and days sales outstanding numbers into a little Excel spreadsheet, chart it, see if we can find any major fluctuations in those numbers. If they look pretty steady, move on. As you get to know your business a little bit, these conclusions probably become self-evident, but our authors note that when accounts receivable have grown more quickly than sales, you may find that the lower accounts receivable turnover ratio, higher percentage of accounts receivable to sales, lengthening of the days sales outstanding. The rationale for that, more lenient granting of credit. And when these numbers are growing, that might be because management's getting more lenient with credit. If you're in between a rock and a hard place and you're trying to make your number, well, let's grant more credit. I was listening to a podcast on the way over here tonight. I think it was maybe The Daily. It was talking about car sales. One of the tricks that is attracting a lot of attention from our regulators right now is this practice called yo-yoing, where car salesmen will make the sale, but in that contractual language, the dealership has the right to revoke that sale if they don't get the credit terms that they need when they go to flip that loan. So a dealership, they'll sell a car, they'll do the financing paperwork. Typically, that financing paperwork is based on the notion that they're going to flip that loan and sell it to Ford Credit or Toyota Credit. Well, sometimes they can't sell that loan as quickly as they want to or on the terms that they want to. And right now, the contracts are allowing them to call somebody back on the phone and say, hey, Mr. and Mrs. Jones, remember that car you bought? Well, I need it back. And this is called yo-yo. So that's very, as you can imagine, that's very, very aggressive, but that would show up in some of these numbers. So that might be a management team reaching to book more revenues, and ultimately that's probably going to come back to them in terms of accounts receivable that don't pay up. This is the spreadsheet I want you to put together. we've talked about most of these ratios already in class. As you build your financials out, you can import them from a variety of different sources. This is something else that you might be working on throughout the semester. When we look at each of these, it's very, very helpful to have the income statement and the balance sheet in an Excel file. As you build that Excel file, creating these ratios gets a lot easier. As you do that, chart this back. If you can go 10 years, please go 10 years. But 5 would be the minimum, and that's one of the reasons why I suggested picking from the list that we picked from, was so that this accounting would be actually doable. So you can see that the accounts receivable turnover for Pfizer has varied from 5.5, 5.9, 6.4, 6.4, 6.6. So their number's going up, which is good. They're turning that accounts receivable over faster, which would be a general indication of health. Average days sales outstanding went from 65, 61, 56, 57, 55, another general indication of health. Okay, great. No red alarms there. Actually looks pretty good. Okay. Only a couple more slides I wanted to touch on tonight. Our authors leave us with learning objective number 6, which is to analyze operating expenses and discontinued operations. But there's not much analysis in learning objective number 6. The authors take us through the major roll-ups or the major categories that typically hit the operating expense section of the income statement. One of the challenges to accounting is that management teams take a lot of liberty with their naming. Now, the accounting principles are the same for all companies. But when you start digging into the accounting, one of the most common questions I get is, well, here's a presentation on the income statement, and I can't tell what it is. And I apologize because I'm probably not going to be able to tell what it is either, because there's so much flexibility and leeway management teams can take in building their income statement with regard to the naming conventions. The answer to that is always in the fine print of the 10K. You got to go digging, and there will be some disclosure that describes it. And you have to take that description and map it back to some discussion we've had in class, some slide we've reviewed, or some language in the text. So here are our major roll-ups. You're going to see cost of sales, selling informational and admin expenses, research and development, amortization of intangibles, restructuring, provision for taxes. These are all just pretty standard, and our authors are taking us through the language and the descriptions of each. Hopefully this is common sense in nature, but our research and development represents a good example of the type of treatment you would give every one of these categories. What you want to look at is, again, time series analysis. So you want to look at these across times, how they've varied to other categories, usually as a percentage of sales. And for R&D, if you're looking at a company like Pfizer, you want to see research and development costs as a percentage of sales, strong over time. So I don't know what Pfizer is. If it's been 8 to 10% of sales for the last decade, then what you'd like to see is Pfizer continuing to invest 8 to 10% of sales in their research and development costs. Otherwise, the logical conclusion would be, well, the company's in trouble. They're purposely neglecting their pipeline. They're not investing in their pipeline for new drugs. So their future revenues are going to dry up at some point. Drug companies can't just cease to invest in R&D. There won't be anything to sell. Now, in that business, so pharma, if they're struggling in R&D, sometimes they'll just go out and buy it. So then Pfizer's done that. Pfizer will dial back the R&D expense periodically, and they'll take all that cash and they'll just go buy another smaller drug. And that satisfies their R&D. So you see mergers and acquisitions take the place of that over time. That's one of the nuances that you have to be able to tease out by looking at the accounting. And I talked last time we all got together about about using the investor relation departments to help you answer those questions. So lean on them. They're here to help you if you're having trouble with thinking about it. Okay, I want to touch on pro forma as you're going through all these numbers as issued by the management of the companies you're looking at. You're going to see press releases that focus on pro forma numbers. Translate pro forma as non-GAAP, which means we can make it say anything we want to say. And that's management team's effort to try to get you to focus on the numbers that they think are most relevant, which begs the question, do we believe management when they say these numbers are most relevant? Why are they trying to get our focus over here? Some management teams do it for good reason, and they have great rationale, and they'll explain that to you and help you understand the pro forma numbers. And maybe that's where our attention should be, because they've stripped out some of the non-operational, non-recurring items. Our focus is on the recurring items most of the time, because the value of the businesses that we invest in is primarily based on future cash flows. So those assets which will generate those future cash flows are most important to us. And management will generally direct our attention towards those assets. So if everything's on the up and up, there may not be anything wrong with pro forma. But if everything's not on the up and up, then you're gonna see a management team issue pro forma numbers that's a smoke and mirrors type of exercise, where they may have something over here they're trying to hide, and they will talk very, very persuasively about why you don't need to be paying attention. So just look at all pro forma numbers with a grain of salt. And then lastly, slide 63 might be the best slide in the whole deck, because it is a summary of this class. When we sit down to go through the whole exercise of analyzing a company's financial statements, we want to go through these key steps. Firstly, let's look at the external audit report. Are the auditors telling us that these financials are representative, or is it a qualified opinion? Now look at the footnotes. Compare the key ratios. Do an analysis of the competitors' ratios so that we can understand how this company stacks up relative to its industry. Identify non-recurring items. Recast the financial statements if necessary. Okay, gang, that's module 5. Thank you, appreciate it. Let me know if you have any troubles with that exam. I don't remember when we meet again, but we met twice in a row, because I'm out next week, maybe 2 weeks. Look at the syllabus and I'll see you back here. Thanks, Sim crew. Have a good night. Happy Valentine's Day.
This is